He's chief market strategist with the Carson Group. It's good to see you again. Why is that your call?
Yeah, thanks for having me. I thought you were going to bump me there with the president, but thanks for having me back, Scott. You know, listen, I think listeners should know this. February historically isn't that great of a month. Okay, that's fine. Post-election years, it's the worst month on average. But here we are, you know, doing pretty darn good. Like you mentioned the previous segment, we're like 8 or 9 points away on the S&P from a new high. What I think really matters, though, it's that second half of February, right about now, right about Valentine's Day. Happy Valentine's Day, everybody. You start to see kind of a banana peel, if you will. Now, you don't blindly, Scott, invest just on seasonals and seasonality, but I think it's really important with all this news that we're having. We've had big down days on Fridays and Mondays because everybody's worried about what might happen over the weekend. I know President Trump just talked. Obviously, we're bouncing now. We know that can change in a hurry. So I think what I'd feel more comfortable with if we start to see more strength on Fridays. But the reality, again, just be open to the idea next couple weeks. Might be more consolidation, a little choppy, perfectly normal. It's just important to know that.
Do you think a tariff-related pullback is inevitable?
Yes, I guess is the short answer. You know, we're going to continue to get the headlines. We're going to continue to get the worry that's out there. I'm sure on your network earlier today, people talked about that AAII sentiment poll, the highest level since right after that 10% correction, late 23. Before that, regional bank crisis. Before that, the end of the bear market in 22. So investors are very, very worried right now when you look at that. But the flip side, Scott, I look at put the call ratios. There's actually some calm and maybe too much optimism there. So it's like this barbell. Everybody's kind of confused. The reality, though, we probably see more volatility. I mean, to think, last comment on this, to think this year was going to be the only year without bad news, without bad days, without probably a 10% peak to trough correction, we think it makes sense. I'm still bullish, but only 2 years say we're in a bull market. Surprises happen to the upside in a bull market. Just prepare probably for more volatility. And honestly, the first half of a post-election year, that's usually when you get it.
I mean, you're still expecting a big year. Maybe not quite as good as what was delivered in 23 and 24, but 12 to 15% upside from here's your call?
Yeah, that's exactly right. I mean, we said at the start of the year, 12 to 15% total return, kind of like some of your previous guests before I came on. We think that broadening out is going to happen. I know everyone's saying one cut, you know, from the Fed. We think it's going to be more like 2 or 3 because we do expect inflation to improve. I mean, what did we just see last week? We saw hundreds of thousands of jobs just evaporate, in essence. But GDP has been revised higher. What's that tell us? Stronger productivity. Go look it up, everyone. In years with strong productivity, you tend to have higher upside economic surprises and strong stock markets. We still think, you know, this bull market's live and well, but small, mid, industrials, financials, those are the areas that will probably do a little bit better when all is said and done.
Well, I mean, you better hope you get a good February CPI report, right? I mean, early March is going to be really critical for this market, especially after what was just delivered. This next read can't be equally as hot, or are we going to have a problem?
Well, that's true. We very well could. History doesn't repeat itself. Often rhymes. Mark Twain. What have we seen 3 years in a row? That January CPI number came in hotter than expected. I know other guests have talked about this. Even last year, February came in a little hot, too. So, you know, maybe we do see that a little bit. But again, the underlinings, the rents have been improving. Look at today's PPI, some of the components that go to the PCE, bunch of letters, I get it. That's the one the Fed looks at, looks better. That's why we're rallying today. We rallied before the president spoke, and obviously he said maybe kick the can on tariffs, at least for today. That's why we're rallying. But the reality, again, inflation is probably still going to improve. Might not do in February, might be later in the year, but it's still going to be a positive. And our big, I guess you want to call it, call here is there going to be more cuts. Right, we've actually added some treasuries. We added some tips, some of the models we run for our Carson partners a couple weeks ago. So we think, you know, the longer-term treasury makes sense. Longer-term treasuries make sense as the Fed cuts a little more than is being priced in right here.
What about Meta? Meta's run, NVIDIA earnings, and the way that a lot of the mega caps have traded lately?
Yeah, you know, well, obviously Meta's in a world of its own, but I know I've come on with you for well over a year saying we're more neutral large cap tech. We're more neutral Mag 7. Trust me, we have exposure to those areas. We just think, you know, the bar is awfully high. Look at the reaction to earnings from the majority of those Mag 7 names. Solid earnings, making a ton of money, but they kind of sold off a little bit. So that's okay. We're more neutral tech. We just think that baton is passed. The lifeblood of a bull market is rotation. We're seeing rotation. That's a great sign.